This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
Where we want to educate you about our market, empower you to make wise decisions, and help you engage with our expert contributors. One of the things we want to find out today, Leilani, is how do you guys come up with these interest rates? I mean, what goes into the determination of somebody's interest rate?
Well, it's funny because this actual topic came up with why are different banks offering different rates, or why is it on the internet?
Right.
Well, it has a lot to do with what the current market rates are doing. Rates can change on a daily basis, 2 or 3 or sometimes 4 or 5 times a day. Credit score, what type of financing that they're doing, what type of occupancy they're doing, what type of property type. Like you would have more of a risk for a condominium, let's say, than a single family residence. So that is built into the portion of that rate as well.
Is there a big difference in terms of rate if I'm going conventional versus FHA?
There can be.
Okay.
Lately it's been the government rates, the conventional, and the FHA and the VA rates are a quarter or a half point sometimes better than conventional. There was a flip-flop a couple of months ago, but where it shows itself in the credit score in the conventional loan is the private mortgage insurance.
Gotcha.
So that is where sometimes, even though the rate might be a quarter percent higher, you're going to save a little bit with a higher credit score on the private mortgage insurance sector of that loan as opposed to any of the government ones.
And when you choose FHA, even though it's a lower rate, you're going to be dealing with mortgage insurance throughout the duration of that loan.
Life of the loan, yes, until you refinance out.
Right. But with conventional loans, you can, if you don't go in 20% down and eliminate it immediately, you can eliminate it eventually. You keep the loan, but eliminate the mortgage.
You can.
Usually, mortgage insurance, I should say.
Right, and typically it's about 11 to 12 years, depending, if you just keep the payments the way that they are and put a little bit towards principal. Okay. But if you're starting out of the gate with 10% down, that private mortgage insurance could go away in about a year or two, depending on the private mortgage insurance company that
What's the cutoff, like 12% down?
Technically, it's 78% loan to value. So most of the time, most banks will say, okay, well, show us an appraisal. You've already been into the house a year. You've put a substantial down payment down on top of the 10%. You've put a little bit more towards the principal. And that's usually for those that have a house that they're selling, and then they're buying another one, but they don't have it sold yet.
Right.
So now they want to go ahead, and we do recasting of loans as well at Southern Fidelity Mortgage.
When you say recast, tell me if I'm explaining this right. I can take out a loan and buy a house, and then when I sell my old house, I can take part of that balance and buy down the principal on my new loan. Correct. And you guys will recalculate my payment based on the new principal with the same interest rate I had before.
That is correct.
And it's just a nominal fee to do that.
Yep, about $250. It's that. But and really, there's not an appraisal, so it has to be at least $10,000 more towards that principal payment. Right. That recast.
And otherwise, though, if you pay down the loan, your payment remains the same. Right. That's the big difference, right?
Well, the payment doesn't. The interest rate stays the same. So the payment's going to be recast of what the new principal.
Right, but if you don't do the recast, if you just pay down your mortgage,
your payment still stays the same.
Your payment is the same over the many years. So this allows people to do a one-time, in a sense, pay down, and then their payment modifies.
Right. Or in the type of the recast, you could actually do it once every 12 months.
You can do it more than once? Wow.
Yeah.
Oh, I thought it was a one-time thing.
Wow.
One time every 12 months.
Holy moly.
And reminder, it's for the conventional product only, not for any of the government loans. But, I mean, certainly you can pay down the principal on that. It's just where the mortgage insurance lies on those. On FHA, it's for the term. And I was going to say something to the effect, you don't have to refinance. I mean, you still do for those that need to. Yeah, if you want to convert a government loan into a conventional. But that saves that refinance closing cost fee.
Yeah.
Right? It's that one fee. Now, a little caveat. Some of the investors actually require 1 month's payment being made first on the existing.
For the recast,
and then doing the recast, and some require 2.
This has been Las Vegas Real Estate Now. Thanks for listening, and remember to tune in every Tuesday morning at 9 a.m. on 101.5 FM, 720 a.m. KDWN.